Welcome to the eMortgage Management Hour, where E is for education. I'm your host, Scott Pendleton. Today, we've got a couple of guests in. Before I get to that, I've got to do my disclaimer. eMortgage Management is a licensed mortgage banking firm, NMLS number 2926, and all our contact information can be found at tampabay.emmloans.com. So now that I've gotten that out of the way, get to our guests today. We've got a couple of new topics and two great guests coming into the studio today. Number one, we're going to be talking a little bit about divorce and how it impacts your real estate investments. Not necessarily an ideal topic. Nobody wants to necessarily talk about divorce, but the reality is, over 50% of the population is going through that. And, when you're going through divorce, a lot of real estate is typically involved in those situations. So today we have Nicole Denman from Denman & Denman Law. And Nicole's going to go into some real specifics. I'm going to kind of talk about the topic a little bit here in the first segment, and then Nicole will give us some real specifics, and I'll ask her some questions, and she's going to school us a little bit on some of the things to think about. Also, in the second segment, we're going to talk a little bit about investing in real estate, owning real estate as an investment, and why you should or shouldn't, and talk about maybe some of the pluses and negatives and some of the pitfalls. To talk to us today about real estate investing, we've brought in Anthony Diodati with Silver Bay Investment Group. Anthony and I have worked together pretty closely over the last couple of years. Anthony does a lot of real estate investing, and he's going to, once again, educate us a little bit on the real estate investment side of things. So just a quick overview about eMortgage Management. We are a mortgage banking firm. We specialize in residential mortgage. We're not a bank. We don't take deposits or sell CDs or any other financial products. Really, we focus on one thing, and that's closing mortgage loans. We're just a mortgage banking firm. When I say just a mortgage banking firm, that brings a lot to the table, but we're not We're not worried about where you're depositing your money or anything like that. If you have any questions regarding a refinance or a purchase, you can always reach out to us on our website, tampabay.emmloans.com. You can click on the Contact Us button on the top right-hand section of the page, and we're happy at any time to answer any mortgage-related questions that you have. So please reach out to us. A brief introduction of myself. My name is Scott Pendleton once again. Been in mortgage banking here in the Tampa market for about 16 years. Love what I do. I try to really attack the business from a high integrity, high ethics standpoint. Really want to make sure that we're educating our customers and doing the right thing for them. And that's very important to us. I'm also a veteran of the United States Coast Guard. Had a short but great career in the Coast Guard. I have a soft spot in my heart working with active duty and veterans of the military. We have a program called Heroes Home Advantage, which has been very successful for us. We're the national lender, and that program is available to our veterans, active duty military, first responders, teachers, healthcare workers. And if you'd like to get some more information on that program, as always, you can go to tampabay.emmloans.com. With that being said, I want to kind of jump into our first topic today, and we're going to talk about – hold on. I had to do it. I'm getting old. I have to put my readers on. I can't see what I used to be able to see when I was a younger man. So when you start talking about divorce, a lot of times divorce involves real estate. So love fades away, marriages end, but the mortgage you agreed to pay when you were in love remains your responsibility. So what are you going to do with that piece of property? What are you going to do with that mortgage? Especially if both spouses sign that note and mortgage, you have a fiduciary responsibility. You owe that debt. And usually a mortgage liability for a couple is one of the biggest liabilities that they have. It's one of the, one of your largest investments, and we're going to talk about real estate investments with Anthony in a little bit. So in the eyes of the mortgage lender, you remain married and liable to that mortgage unless you sell the house or refinance. So just because you get divorced and that marriage breaks apart, that doesn't mean that your responsibility to that mortgage changes. Now, contrary to what you'll hear from a lot of mortgage professionals, I'm going to tell you, I think probably your best option, and this is strictly my opinion, if you have a piece of property and you're going through divorce, you really should try to sell it if you can. That's probably, at least in my opinion, that's your best option. Get rid of that piece of real estate. You got to move on. But there's, been a lot of things happen with the housing bubble burst and the housing market the last several years. You may be in a situation where you're upside down in that house and you may not be able to sell as easily as you would like to. That's when we start having conversations about short sales and things of that nature, where you're selling the house for less than what you owe on it, and that becomes a different conversation. What I would tell anybody, if you decide to sell a home, make sure you're working with a realtor that understands the process, that understands how real estate affects divorce. Make sure you're working with a realtor that's a full-time professional, that this is what they do. Now, should you decide to keep the house, one spouse, you also have the option to refi. Now, obviously, that's where we as a mortgage banking firm would come into play. So a couple of questions come into mind there. Are you underwater on the mortgage? And like we talked about before, if you're underwater or upside down, does the spouse that wants to keep the property have sufficient credit and income to qualify? That's something you got to think about as well. You're going from two incomes to one income. Does that one spouse make enough money, have good enough credit, or have the assets necessary to qualify for that mortgage? So you got to keep that in mind. And does the other spouse want to let the house go? I know, God forbid, if something happened in my situation, my wife would want to keep the house. If I decided I wanted to keep the house, now you've got some conflict there. That's why you hire a divorce attorney like Nicole to help you with those conflicts. I think the thing you need to ask yourself in that situation, if you were single, would you buy this home? To me, that's a simple question you can ask yourself. And I use myself as an example because I don't know everybody out there. I know me. I've been married for 17 years. God bless. I hope that never changes, knock on wood. Love my wife very much, and I hope I'm married for a long, long time. But if that situation were to arise, the question I would ask myself, if I were single, would I buy this home? And for me, it would be no. I don't need a house that big. All the maintenance and everything involved with having a large house, I wouldn't do it. So, that to me seems like a very, very simple question. Now, when you start getting to that area where you're thinking, okay, one spouse, I want to keep the house. Can you get can you do that? That's simple. Call us. We can run the numbers for you before you make that decision and tell you, okay, Mr. and Mrs. Jones, here's where you stand today based on your current income. You've got to think about different things. For example, if it's a husband and wife situation, the husband or the wife want to keep the house. If you're paying alimony or child support, we have to be conscious of that. We've got to include that in your debt-to-income ratio. So what you think you can afford, maybe you can, maybe you can't. But it's a simple phone call. We can do an application over the phone typically in about 10 minutes and have answers for you within about 30 minutes and let you know where you stand. So once you've been through that scenario, and maybe you have gotten divorced, can you get a mortgage after divorce? And a lot of those things come back into play. Are you receiving alimony and child support? Great. We can help. That's additional income. Are you paying alimony or child support? Not so great. It affects your overall debt-to-income ratio. I see two scenarios that are pretty typical. You sell the house. You and the spouse decide we're going to sell the house, and you want to go buy a new home. And I'm dealing with that exact situation right now with a friend of mine. Unfortunately, he and his wife decided after 20 or so years they were getting divorced. They finally have their house under contract now, their marital house, and they're ready to move on. And the question that he has is, do I qualify? So, I'm working with him right now to kind of put those numbers together to let him know if he qualifies. But once again, before I can make that decision for him, I need to know what's going to happen in the divorce. Is he going to be – I know he's going to be paying alimony and child support. So those are a lot of things that come into play, and we have to think about that. Or one spouse keeps a house and decides that he wants to refi. Once again, that spouse that's going to refinance that's great. But if they can't for some reason – If for some reason, and Nicole will probably hit on this in much more detail and be much more eloquent, but when you're in a situation where you've got a divorce and it says, okay, husband, you're keeping the house. You have 6 months, which is a typical time frame. You have to refinance this house into your name only and get the other spouse, your ex-wife, off that mortgage. Well, that's easier said than done in today's housing market because if you're upside down, if there's no equity in the home, it becomes very difficult to refinance. Now, there are options. There's HARP loans. There are some things that we can discuss with you to maybe give you some ways to get that deal done. But in those situations where you can't, you're kind of stuck. So now you've got another spouse that wants to go buy a house, that ex, they want to go buy a house because they didn't keep the marital home. How are they going to qualify? Now, typically, if the divorce clearly states that your former spouse is responsible for that mortgage, we can exclude that mortgage payment from your debt and your debt to income. But once again, that goes back to making sure you hire an attorney that knows your plan moving forward and can structure the settlement agreement correctly so it works in your favor. And that's very important. So with that being said, that kind of leads me into introducing Nicole Denman. Nicole, tell us a little bit about yourself and your firm.
Hi, Scott. Thanks first for having me. I do appreciate it.
Well, great to have you.
My name's Nicole Denman, and I'm a Stetson College of Law graduate here locally. I founded Denman & Denman with Christian Denman, that's my husband, in 2010. We practice in a variety of different practice areas. We have 3 offices in the Tampa Bay area, here in Hillsborough, Pinellas, and Pasco County as well. Our 2 biggest practice areas, which hopefully I'll get to talk a little bit about both today, one of them's divorce and the other one's estate planning, and I hope to kind of touch on that. I know we're here to talk about divorce, but people forget about the estate planning aspect of divorce as well. So hopefully,
well, that's a big part of it, and I can't tell people often enough. I mean, I had my will, estate, everything done when I was in my early 30s. As soon as I had children, we had our estate planning done. Mm-hmm. Now, when Nicole and I met, it reminded me that it's been a long time since I've looked at my stuff and I need to relook at it. But it's very important, and especially when you're going through something like a divorce and there's children involved, estate planning is crucial. So
Absolutely. And people don't think about it, although divorce is a life-altering event. And I say every life-altering event, you need to think about the estate planning stuff. But we'll touch on that. Let's talk about the divorce stuff first, because I know we want to touch on that.
Yeah, so a lot of people going through a divorce own at least one residence or property jointly with their spouse. So what happens with that jointly owned property during the divorce?
Okay, so first let's talk about jointly owned property, because some people think, oh, okay, I found out I'm not on the deed to the property, and so it's not mine. Okay, so we have a lot of particularly wives that go through that. Maybe husband is taking care of the financials, he's been the breadwinner, and somehow he ends up on the deed to the property. That does not necessarily mean that you are not entitled to a portion of that property. If the property was acquired during the marriage, then it is, in fact, marital property, and the courts can address it and deem it marital property, whether or not your name is on the deed at all.
Right.
Also, if the property was acquired prior to being married, so perhaps there's a wife and she had a condo or something to that effect prior to the marriage and then gets married, but after the marriage, both the husband and wife contributed to the mortgage payments and things of that nature for the condo and expenses, then the wife is also, and the husband are both going to be entitled to a portion of that property as well. Then part of it is deemed marital property.
Okay. See, now I didn't even know that. Mm-hmm. And one thing that comes into play that I run into, and it's kind of an unfortunate situation, when we have those people that are in the midst of a divorce. In the state of Florida, you're either married or you're divorced. There's no really such thing as legal separation. So what I run into a lot in the mortgage industry is people are going through a divorce. They've already kind of split up, and divorce can take a long time in certain situations. They've moved out. They have separate homes, and one spouse wants to go buy a property. Well, if you're still married, that becomes a very difficult proposition, especially if you don't have a good relationship with that soon-to-be ex. Because in the state of Florida, we're a marital state, a spousal state. You cannot buy an owner-occupied piece of property in the state of Florida without your spouse being involved in that transaction. So it becomes very difficult. And that's a hard conversation to have with people. I've had to have that conversation twice this week.
Oh, yeah, absolutely. People think it's going to be really easy. I'm separated, per se. We're not living in the same residence. I can go out and do what I want.
Yeah. No.
You can, but you have to have your spouse sign off on everything as well.
Yeah.
Still, until you're deemed divorced by the court.
Right.
So
and I, once again, it goes back to that integrity thing. I want to get people into homes. I want to do mortgages because that's how I make a living. But my advice to most people is wait till you're divorced. Get the divorce finalized. Go buy your property. It's free. It's clean, and you can move on with your life. Mm-hmm. So what happens when there is equity in the home and either the husband or wife remain in the home?
Well, let's kind of backtrack a little bit. First, okay. I want to talk about, and then we'll get to that because I don't think I quite finished up. That's probably my fault. Okay. But if you are going to, if the court's going to divide your marital property for you, they can do basically three different things. The first thing they can do is they can force the sale of the home, right? Or the parties can agree, right? So parties can agree to anything to the sale of the home, right. And then the equity is divided, or the liability is divided, whatever there is. The third thing that can be done is the court, as you said, Scott, is they can allow one party to remain in the property, and that's where it gets kind of tricky.
Right.
You advised, hey, let's go ahead and sell the property. In an ideal world, every divorce I did, I would advise that, but sometimes it just doesn't work out that way. But if there is equity in the home, that leads to the next question, what can the court do? Well, the court can say, and one party stays in the home, then the court can then say, well, I'm going to allow wife perhaps to stay in the home because there are minor children. She's the primary custodian of the minor children. That's a situation that occurs quite frequently and quite often. Or dad, right?
Right, makes sense.
Whichever one is the primary custodian. But there's $50,000 in equity in the home. So what do? How do we credit dad his $25,000 of that $50,000? Well, you have to go into the other assets, right? So basically, dad would be getting a credit from the other assets of an additional $25,000. So basically, we'd be reaching into something else that is jointly owned property in order to give dad a credit to offset the equity in the marital home because one party wants to, or because the court ordered one party to stay in the marital home.
Like maybe in a retirement account or something like that they could pull from.
Correct. IRA, annuity, retirement account, 401k, anything of that nature.
Right. Mm-hmm. Now, would it be possible, and this was, of course, mortgage guy thinks, right, like a mortgage guy. What if that spouse was going to stay in the house and they've got enough equity? Why not just do a cash-out refinance? If there's enough equity, you keep the house. You're killing two birds with one stone. Mm-hmm. You're giving the spouse their cash, their $25,000 in that scenario. Plus, you're doing it in your name. You're getting the spouse off the loan, off the mortgage. At that point in time, you can make sure in divorce it says they have to sign a quick claim deed and get that person off of there.
Absolutely.
Right.
And you know what? Anybody can agree to anything during a divorce. That's the best case scenario, and I wish everybody did. Unfortunately, they don't. And I don't know why the courts don't do that more, why judges don't order that more. Mm-hmm. Unfortunately, they don't. Maybe they just don't think of it. But absolutely, if you have a financial savvy couple, I've seen that happen time and time again.
Gotcha. So what happens if the home is underwater? More is owed on the mortgage than the home is worth, and one party remains in the home. And unfortunately, we saw a downturn in our market the last 10 years or so. That situation is probably more common than we'd like to see.
Absolutely. I think it's getting better in the last few years, but
I agree.
It was really bad there for a period of time. What basically happens is if there is a liability, the same thing that would happen with an equity, but in the reverse. So one party gets an offset from the marital assets for the liability. So maybe husband stays in the home, but there's a $100,000 liability on the home, which I don't know why they would choose to do that, but some people do have that emotional attachment to the home or want to stay in the home. Mm-hmm. But there's a $100,000 liability, so they have to be paid $50,000 or half of that liability, the wife's liability, from somewhere. So it comes from a different asset. Now, on the other hand, there is the foreclosure and short sale issue, because a lot of the people that we're dealing with are in the midst of foreclosure or short sale, because part of the reason they're getting divorced is financial issues. They can't agree on finances. They're having issues. Unfortunately, that's the cause of many divorces. Yeah. So what do we do then? Well, when there's a foreclosure or a short sale, oftentimes, and I think this is a great scenario for many people, one party will actually stay in the home until the foreclosure or the short sale is complete. And that way that party can continue to live in the home. Although they're not making mortgage payments per se, they're living in the home for free at that point until the home is actually foreclosed upon or a short sale occurs. Once that happens, then there's a liability, obviously, and then the courts retain jurisdiction to make sure that that liability is split between the parties.
And hopefully while that person is living in the home without making mortgage payments, they're saving that money and setting themselves up for future purchases or whatever the case may be. And we did a show about 3 or 4 weeks ago regarding negative financial events and how they affect your ability or capacity to be able to purchase a home in the future. And if you have any questions on that and specific guidelines, I mean, we do have it. I have an investor right now. If you've got 20% down, one day out of bankruptcy, one day at a short sale, one day out of a foreclosure, you can go get a mortgage and buy a house. Now, obviously, 20% is a lot of money for most people. You know, if you start talking about, a $200,000 house, $40,000 is not chump change. That's a lot of money. So it becomes a very kind of specific scenario. But, the moral of the story is there's options there for you. TampaBay.emmloans.com. We're always there to answer your questions and help you out with that. What occurs if a party cannot refinance only in their name?
That's a tricky question because ideally, we all agree that one party is going to stay in the home, that party is going to refinance a mortgage in their name because once you split, you don't want that obligation anymore. Unfortunately, though, as you were talking about, Scott, at the beginning of the show, that's not always possible. So Oftentimes we have a party in the home that their salary is not high enough. Their credit's not good enough. They just can't potentially refinance the home that they're in when they make $30,000 or $40,000 a year, and the mortgage on the home that's existent is $200,000. It's just not a possibility. And unfortunately, the other person that's on the mortgage is just going to end up stuck on that mortgage.
Right.
And the reason is because the courts and what the case law says is that, look, we can't intervene. We would like to. It's fair for us to intervene, but what are we going to do? If a person is making their best efforts, obviously they would have to show that in court. Look, I've gone to this many places. I've applied for the refinancing, and I just can't get it. Then there's nothing we can do because we can't force the bank into refinancing.
Right. They've got
or the mortgage company.
Right. They've got to qualify for the loan at some point in time, and if they don't qualify, unfortunately, they're stuck between a rock and a hard place.
Exactly.
There's only so much you can do in that situation. Now, once again, you go back to that divorce, that settlement agreement. The good news is for that spouse that is stuck on that mortgage, if the settlement agreement is very clear and concise that the other spouse that got the property is responsible for that mortgage, there's always a very good chance that we do not have to count that into their overall debt-to-income ratios. Now, if that other spouse stops making the mortgage payments or anything like that, it could still have a negative impact on their overall credit. But from a lender standpoint, we get it and we understand, especially in today's market, that there's a lot of situations like that out there where that spouse that kept the property and is court ordered to refinance, well, they just can't. They're either upside down or underwater, or they don't qualify. So, we don't want to penalize the other spouse for that situation.
And I see it all the time. I do see people that they're just stuck. Yep. They knew that might happen, but the other party has attempted to refinance. They're stuck on the mortgage, but then they turn around and within a few months they have another mortgage. So it does happen. It's not absolutely preventative of them getting another mortgage.
It's not the end of the world. Right. Usually there's some options there. Are there any other actions that should be taken after divorce in regards to a property retained during divorce?
Absolutely, and that's where we get into those estate planning documents I was talking about.
Absolutely.
Because we're talking about deeds, we're talking about mortgages, we're talking about taking your name, and I think we did mention briefly one party needs to go ahead and quitclaim their portion over their interest over to the other party if that's what they're going to do and relinquish their interest, and that party is going to stay in the home. But we also need to focus on the estate planning documents. A quitclaim deed is actually considered a quasi-estate planning document as well. So the estate planning documents, I'm talking about last will and testament, designation of healthcare surrogate, living will, all of those things. Because you have to remember, even if you're doing all these things and taking the person off of the quitclaim deed and they're no longer your spouse, if you're leaving these things to this person or your ex-spouse in your will, you have to remove that person and put somebody else in their place, because otherwise nobody's going to intervene. They're just going to assume that you had a great relationship with your ex-husband and you wanted to continue to leave these items and these things to your ex. So that's really, really important. And the healthcare documents, because why would you want to have your ex go ahead and make your healthcare decisions for you.
Well, that's great. Listen, Nicole, I want to thank you for coming in today. You've given us a lot of great information. I hope nobody has to go through a divorce, but if they do, Denman and Denman law firm, they're available for you. Reach out to them. They're easy to find on the internet. We'll be back in just a few minutes. Welcome back to the E-Mortgage Management Hour, where E is for education. In this next segment, we're going to be talking to Anthony Dianati with Silver Bay Investment Group, and we're going to talk a little bit about real estate investing. Why? Things to consider before buying your first investment property or your second or your third. Once again, I kind of relate back to myself. I owned, in my time before the bubble burst, I owned a few residential properties and a commercial piece of property. And I'll be honest with you, had I be given the option to do or not do that again before the market burst, I probably would not have done that. But, you can't time the market. So I think it's very fitting that you do your research and really understand what real estate investing is about. And are you really ready to invest in real estate? And if you watch any shows like Home and Garden Television, you know that real estate investing has become very, very popular. 90% of their shows are about buying property, investing in property, flipping properties, and doing that. So I think probably one of the most crucial and important things to think about before investing in real estate. And when I talk about investing, I'm not talking about the home you're going to live in. Maybe you already own an owner-occupied residence. It's your house. You, your spouse, your kids live there. I'm talking about buying another piece of property, not even a second home, not a place you're going to go to on the weekends, not a condo on the beach. I'm talking a true investment property, something that's going to make you money. And I think probably the most important of that is do you have a plan? That's one question that comes to mind. If you're going to invest in real estate, make sure you have a very substantial plan. And if you don't think you know how to put that plan together, that's when you have to turn to people like Anthony Dianati at Silver Bay, that's also a full-time realtor, and make sure that you talk to them and understand the pitfalls and the benefits of investing in real estate. And then it becomes a question of what kind of property should you start with. Are you going to buy a single-family home that's maybe distressed, fix it up and flip it? Are you going to pay cash for the property or not? Are you looking for a property maybe as a long-term investment, and you're just going to reap the benefit of that long-term income, rental income? I mean, we live in a time where rents are probably higher than I've ever seen them before, and rents continue to increase because, unfortunately, there's a lot of people out there, a lot of good people out there, that were forced out of their properties because of the most recent economic events that we've seen. They maybe went through a divorce and they had to sell a property, and they had to do a short sale. They had a bankruptcy. Their property was foreclosed on. Bad things happen to good people every day. It doesn't mean that they should be excluded from real estate for the rest of their lives, and they're not. But with rents going up, investing in real estate may be very enticing to a lot of people, thinking, okay, as rents increase, it's a good situation. My wife and I have had this conversation. I have a 16-year-old daughter. She's a junior in high school. She's going off to college soon. And we've been kind of playing back and forth. What are we going to do with the house that we're in right now? Well, fortunately, we're in a pretty good financial situation on that house. The market has started to come back for us, and the value's coming back to where it was. But based on my mortgage payment and what I could make in rent on that property, we've kind of had the conversation, why sell the place when the time comes and we're ready to maybe move to a smaller place or get closer to the water, which is my plan. We'll rent that house out. I can make a pretty decent profit on the house on a monthly basis from a rental standpoint. So why not just rent that house out? And that also gives me the option, if I don't like where I go, I can always go back. I can always go back to my house that I've lived in for over 10 years and I know I like. So when you start talking about that, you start thinking about, okay, do I want to buy a single-family home? Do I want to buy a multifamily property? What I see a lot of young people doing these days, and I've seen it in the past as well, is buying a home first time as your owner-occupied residence, knowing that maybe 6 to 8, 12 months down the road, you're going to keep that house as an investment property and go buy another house as an owner-occupied residence. And here's a great thing about that. When you buy a home as an owner-occupied property, you get much better terms. The rates are lower. You have to put less money down. You have FHA available to you with 3.5% down. You could do a 5% down conventional loan. If you're a veteran, you could do 0% down on a VA loan. A lot of veterans take advantage of this because they move around the country a lot. Veterans will a lot of times, or active duty military, they'll be stationed somewhere for 4, 5, 6 years. They'll buy a home there. When they get transferred, they rent that property out. They go buy another home using that VA benefit. So if they have enough eligibility. So that's a great way to maybe get yourself slowly into investing in real estate. And it's a great way to get in with better terms. Some of the other little nitpicky things that maybe you don't think about. What's the neighborhood like that you're thinking about buying that investment property in? That's important. Are people going to be comfortable renting a home in that neighborhood? You should really think about that. The old adage, location, location, location. Is that property going to appreciate because it's in a good location? Maybe there is some deferred maintenance. You could put some sweat equity into the property. But you need to drive that neighborhood. My recommendation, I'd drive through on a weekday. I'd drive through on a weeknight. I'd drive through on the weekend, one morning and one evening, and kind of get a feel for the neighborhood and make sure it's someplace that you'd feel comfortable living. Another thing you need to think about are what are the local vacancy rates. And when I say vacancy rates, I mean how often are these homes in this area vacant, nobody living in them. And I can tell you from a lender standpoint, we kind of assume if you have an investment property, off the bat, we assume that it's going to be vacant or empty 25% of the time. That's a standard guideline for us because, there's going to be times where you're going to have people come and go. You may have somebody move out, and it might take you 3 or 4 months to move somebody new into the property. Now, right now, it's a good renter's market. It may happen quicker, but you have to have that frame of thought because if you have a mortgage on that property, you still have to keep making that mortgage payment regardless if somebody's paying you rent on a monthly basis. You've got to think about, what those monthly expenses are going to be on that property. Understanding those expenses is very important. Who's going to pay the water and sewer bill? Writing that lease on an investment property is crucial, and making sure that you write it in your favor, really. Garbage, utilities, evictions. I've owned residential investment properties. I've had to evict people before. It's nasty business. It's time consuming. If you don't know what you're doing, like I didn't the first time I had to evict somebody, it can be very cumbersome, and it's hard to get these people out of your house. And unfortunately, in this day and age, there's a lot of people out there that really know how to work the system, and they will run you through the ringer. They will absolutely run you through the ringer. So, you got to put all these things, into the thought process, and then. How are you going to handle the financing of the property? Are you going to pay cash? Do you have the funds available? And even if you do, let's say you've got $100,000 extra. God bless you if you do. You got $100,000 and you're thinking about investing in real estate. Do you want to take that whole lump sum and put it on one piece of property? Or do you want to take a little piece, put some money down, and maybe buy 3 properties, put 20% down on each? So you've got to think about that. Now, when you start talking about buying investment properties, the lending guidelines definitely change a little bit because you heard me say earlier, as an owner-occupied, you can use FHA, which you can't use FHA loans to buy investment properties. But if you're going to live in it, you can at 3.5% down. On a conventional loan, 5% down if it's going to be your owner-occupied residence. When you start talking about buying a single-family home, as an investment property, the minimum requirement down by Fannie Mae guidelines is 15%. That's quite a bit more than 5%. That's a substantial investment. Now, if you start looking at multi-unit properties, duplexes, triplexes, quadruplexes, once again, great investments. It's an opportunity where you can buy, 3 or 4 units at once at the right price. Great opportunity. In those scenarios, you've got to put at least 25% down. So that's something to really be conscious of. You've got to really think about that aspect of it. Who's going to handle the bookkeeping on the properties on a monthly basis? Do you have the time? are you going to hire a property manager to manage the property for you? If you're going to hire a property manager, they want, on average, about 7 to 10% of your monthly rent to manage that property for you. Do you want to incur that expense, or are you going to be the guy that they call at 11:30 on Sunday night because their toilet's overflowing? When I owned investment properties, I had a management company because if I wanted to go do something on a Sunday, I didn't want to have to be at the bequest of my renter and go, hey, this is broken. My AC's broken. You got to come fix it. Repairs, huge expense if you're not prepared for it. So, these are all things that you have to be very, very conscious of. And then I think probably one of the next most important things is, do you have an exit strategy? Do you have a plan and an exit strategy? How are you going to get out of this property? Know what you're going to do with the property before you buy in. There's a lot of investors during the last housing boom, myself included, that bought properties with one plan. I'm going to own it, and I'm going to sell it for more than I bought it for. Well, didn't quite work out. When the market dropped, it was a very abrupt change of plans that I wasn't really prepared for. So, you've got to make sure you plan properly, that you have your plan going in, you've got your exit strategy going out, and you know that you're going to be willing, and I think you have to be willing to hold on to this property long term unless you have a very specific plan to buy and flip, which a lot of people are doing. We had a group in recently that talked about buying and flipping properties, a group of realtors that we work with that do it and do it well. But once again, that's it's a slippery slope. It's a dangerous proposition, and I don't think most people are prepared for it. So with that being said, now that we've talked a little bit about my opinions and my take on investment properties, I'm going to bring in the expert. I'm going to bring in Anthony Dianati with Silver Bay. Anthony, thanks for coming on the show today. Tell us a little bit about yourself.
Well, Scott, thank you for having me. I appreciate it. My background is in corporate finance. I used to work for Citigroup, and I've also worked for a private equity firm based out of Tampa.
Okay.
So, while I worked at Citigroup, I was in their real estate division, and we were managing 78 million square feet of real estate that Citigroup owned. Wow. So it was a lot of properties and a lot of work, and it was during that time that I was able to learn the business and really figure out, okay, where is the opportunity in this industry? And that's when I decided to start my own firm. And, just like every other real estate investor, we started with one property, one led into two into four, and so forth. And it's been a fun ride. We've definitely seen the ups and downs.
Sure.
But, the beauty about the business is you learn. And as long as you're learning, you will always do better in the future. So with that being said, we're in the Tampa Bay market right now. That's our main focus.
Mm-hmm.
And we are seeing a lot of opportunity in Hillsborough and Pinellas. But there's also opportunity in different markets that I want to talk about today. If you look 3-4 years ago,
mm-hmm.
when the market was at the peak, at the bottom,
right,
we saw a tremendous amount of inventory.
Oh yeah.
Okay, and the banks were begging you to take their inventory off their hands. It's a completely different market now.
I agree 100%.
And you mentioned something earlier. You said, you got all these TV shows and all these amateurs coming into the game. Well, that's a problem for the investor that's been in the business for a while, and I'll explain why. The problem that we're seeing is when there's too much competition, prices inflate. Acquisition prices inflate, which reduces your return on your investment, right? So, that's kind of what we're seeing happening in the marketplace. So what do we do to protect ourselves and our investors? Well, we are starting to look into different markets like Jacksonville,
mm-hmm.
Orlando. These are the markets that haven't really been tapped into as hard as you've seen deals happen in Miami and Tampa.
Yeah.
Because most of the money in Florida is coming from overseas in South America. The the cash. We're talking cash right now. We're not talking about
right. I'm seeing a lot come out of Canada as well. I see a lot of cash deals out of Canada. Tremendous
amount of equity coming out of Canada as well. So that's kind of a brief of my background and what we're doing.
So give me your take. Why invest in real estate? What's your opinion?
Well, everybody's different. I've always loved architecture, and I've always been fascinated by real estate. And I like the idea of touching and knowing that I can the subject property that I own is there.
It's a tangible benefit.
Correct. Whereas if I owned 5,000 shares of Apple and the stock market crashed, what's that worth?
Right.
So it's a different business model, and it's a model where, I'm a long-term investor, so I want to make sure that the money that I have is placed in a secured vehicle where I see not only short-term gains, but also long-term gains. So that's why, I decided to move forward and focus my investments in the real estate industry.
All right. Well, that's great. So in your situation, how would you determine whether a property, because you said you're interested more in that long-term kind of aspect of it. Now, obviously, you're going to find properties, just like everybody, that's a good flip opportunity. Maybe it's something that's just got so much deferred maintenance, you could put a reasonable amount of money in it and the equity's there. How do you determine whether a property is a good buy or flip?
Sure, and that's a great question. And this goes back to, my background of being an analyst, because all we do is run numbers.
Right.
That's all we look at is we analyze key statistics, the interest rate, and another factor that we look into is building permits within the county to see how many new constructions building permits are in effect. We also we count the inventory. We factor in supply and demand ratios. We also factor in comps, to see, okay, what kind of price difference are we seeing within the last 12 months?
And when you say comps are comparable sales. Correct. What other similar homes in the market are selling for. So, if you've got a 3-bedroom, 2-bath, 2-car garage, you want to find something preferably within a mile to 2 miles that is also a 3-bedroom, 2-bath, 2-car garage, with or without a pool.
The way we run our comparables, for a better lack of term, is the same way that the big banks run their comparables. Because at the end of the day, the property is going to be owned by a consumer, a retail buyer, right? Mm-hmm. And we're talking about flipping properties right now.
Right.
So when we look at foreclosures, we look to see, okay, where are we with price per square foot today? What is the retail value of that asset once all said and done, new kitchen, new floors, new roof, the whole shebang. And then we factor in to say, okay, how is the bank going to appraise this asset?
Right.
Because if we think it's worth $100,000, but the bank thinks it's worth $80,000, well, that's a huge spread.
Right. And 9 times out of 10, that person purchasing that flip property, the guy that's buying that house that you guys have fixed up, they're going to get financing. And when they come to me to get financing, that property has to appraise for the appropriate value. So in that exact scenario, if you're selling it, say you bought it for $50,000, you put $15,000 in it, now you're turning around and selling it, or $20,000 in it, and you're going to sell it for $100,000. If it appraises for $80,000, I have to lend on the lower of the purchase contract or the appraised value. So if the appraisal comes in lower than the purchase contract, I'm stuck at that point. I have to go by that $80,000 value. Now, you as the seller don't have to agree to that, and you can go find another buyer. But what some people don't understand, in that price point specifically, a lot of these buyers are using FHA financing. One little caveat with FHA: once an appraisal is done, it's logged into FHA's system, and that appraisal stays with that property for 6 months. So if somebody else comes along a month later and wants to buy that property using FHA financing, they're stuck with that $80,000 appraisal. So you got to really do your due diligence and do your homework.
And to elaborate more on that, I'll give you some statistics.
Great.
In August of 2015, 34% of transactions were cash-based, okay? And if you look at last year's statistics, that's a reduction of 9.6%. So what that's telling us is more and more consumers are coming to you guys for lending to get loans on the properties.
We like that, by the way.
Yeah. So we have to make sure that when we're underwriting these assets, that our numbers are pretty close to where you guys would come in and say, yes, these are the comps we would prefer to use. So it's not that it's a lot of work. It's just you really have to make sure that you factor in your variable cost.
Sure.
Because a lot of people will look at a foreclosure and say, "Oh, I can fix this for $20,000," but at the end of the day, they're probably in it for $35,000, maybe $40,000.
Right. Yeah.
So you really have to be careful. But it's just like any other business. Once you start with one, you learn, and you just get better and better at it. And and the other thing is, I want to throw in some other statistics for you. Okay. When I mentioned earlier that the market is changing, okay, last year, the amount of short sales that we saw compared to today, we have seen a reduction in 29%. So what that's telling us is the days of short sales and foreclosures are slowly diminishing.
That's good news. I think it's good news for the overall market and strength and stability of the market. I think that's good news.
Correct, but as an investor.
Right.
Our logic is saying, okay, so if this segment is diminishing, where do we go next?
Right.
Right? So the answer to that question is we start looking at new construction. So what you're going to start seeing a lot more of is a lot more of new construction, single-family, townhomes, condos, because the investment groups have pretty much digested close to about 80% of the inventory.
Sure.
And I'm talking about the Tampa Bay market right now. We're not talking about any other markets.
Well, and if you look back and you look back, let's just go to 2005, 2004, 2005. That's really a big portion of what the market was back then. Before the housing bubble burst, ton of new construction. My house, new construction. You could buy a nice house for a reasonable price, and now I'm not talking about custom built homes. I'm talking about tract homes. Like the homes in the West Chase area and Highland Park and other areas. That's the area I live in, so it comes to mind. Sure. But we're not talking about a teardown in South Tampa. That's a different animal. But when you're talking about a lot of that was really the market early 2000s, 2003, 2004, 2005. There were these little gated communities. They were popping up everywhere. Right, construction. Lots of money going into building, and then all of a sudden the bubble burst and all the money shifted to foreclosures, short sales, and things of that nature.
Yeah, it's a just if you look at history, it's a cyclical effect. We see this every 10, 15 years. As an investor, you have to sort of vision the future. Right. So you have to be able to sort of see what the market is going to look like 2 years from today.
So what do you think the market's going to look like 2, 5, 10 years from now? What do you think the housing market – let's just talk about the housing market here in Florida or Tampa. Let's talk I have my opinion. Sure. I know for me, my opinion is I'd like to see slow, sustainable growth. That's what I want to see, because I don't want us to get back in the position we were at before. But what do you think?
I agree with your statement. I think in the long run, Florida will see a long, sustainable short-term growth rate, okay? In the short run, you're going to see a tremendous amount of transactions happening because of the amount of inventory that we had in the short sale and foreclosure sector. There's
still some of that inventory out there, obviously.
There's still some out there, and there's more coming, but it's not as much as we saw 3-4 years ago. But look, as long as you factor in the economic indicators like the interest rate,
right,
and supply and demand,
which interest rates I think are going to stay low for plenty of time to come. So don't freak out about interest rates.
As long as rates stay low, and there's more demand than supply, I think Tampa will be we'll be fine. I love it here. People love Florida. We don't have a state income tax.
I love that.
So there's a lot of benefits to live in Florida. Yeah. And we have the beach, obviously.
I like that too.
You have the weather. So, in the long run, I think we're going to be great. I think there's there's a lot of opportunity in the short run as well.
Yeah.
So,
Well, I got to tell you, I agree with you, a lot of what you said, but just about everything you said. So, I want to thank Anthony for coming on the show today. You did a great job. You gave us a lot of good information. As we move along here in the housing market, you just be conscious of making sure you're working with people of higher integrity. You're working with professionals like the group at eMortgage Management. Come to our website, tampabay.EMM Loans. Contact us. We're here to help you. I want to thank you for coming and listening to the show today. Can't wait to come back next week and educate you some more. Thanks for listening, and we'll see you next time.